Hey everyone, welcome to the KE Report Daily Editorial, Friday, September 5th, chatting with Brian Leni. Brian is the founder and editor of the Junior Stock Review. And Brian, we are going to be focusing on what you're doing with your portfolio, what you're telling subscribers in terms of potential investments in the resource metals sector. Look, undoubtedly, we are in a raging bull market for the precious metals. Gold and silver just had another breakout. The stocks have been outperforming the underlying precious metals. Really, you look at the big guys down to the little stocks, the juniors, we have seen a really revaluation across the board. Yes, we can make the argument these stocks are still undervalued, but these stocks are also 3x at least up from their lows of some just a few months ago, some from last year, some are even higher than that. So, Brian, since you're an active investor in commodity stocks, especially metal stocks, what are you looking at? Where do you see the value? Are you still chasing precious metals?
Well, thanks for having me, guys. Yeah, well, precious metals seem like the place you want to be, or you wanted to be probably a year ago. And if you were invested a year ago in the right companies, you've really seen an appreciation. And I think with this, what seems like the next leg up, at least in the metal prices, is starting to trickle down fully across the equities. From what I can tell, the junior stock of premium portfolio has done exceptionally well. It's well positioned to benefit from gold and silver. And I've been looking at a lot of other companies within the precious metals ilk and sort of following them, waiting for a few things to happen. I thought I had more time, but I can see that, things are catching up quite quick. And when that tide comes in to rise all boats, it certainly comes in quick. And so for me, what I see is there's still opportunity out there. Like I really like the companies that we're in, but I think when you start looking down on new opportunities, taking new ideas on, taking new risks on, I think I'm more attracted to sort of I wouldn't necessarily say they're contrarian, but if you go to the copper market, maybe you go to the nickel market, which I would say is much more contrarian, this is where the best opportunities are. This is where companies are selling for, let's say, less than 2% of their NAV at today's metal prices. And that's really where you get that margin of safety from my perspective. Just sort of take on those new risks and maybe invest in new people or revisit, deals or stories that you were in the past that are now selling at large discounts that have, good future ahead. So I've definitely, not to say that I'm pivoting out of precious metals, I'm not. But I think if I'm going to add any new companies, at least in the next little while, it's going to be on that value side of things in the coppers, the nickel sectors, where I see some, screaming buys.
Yeah, Brian, it makes sense to start looking at what is more undervalued, where you can see that potential setup similar to where precious metals were a year or two ago. But you talk to your subscribers and you have a good group and a good following. And I wonder how you navigate the psychology of the people that you talk with, because people don't really want to buy when things are low, as we know. People want to wait until there's a trend, until there's momentum. And so what we're seeing right now with gold and silver has those animal spirits awakened, and people are like, "Oh, this is a great time to get started," or "This bull is just getting started." And it doesn't seem like it's just getting started. It seems like, we're well into it at this point. So how do you deal with communication with just your own subscribers or even people listening here that feel compelled now to pile into a sector that's hot instead of looking at where the real value is?
I think you're bang on, Chad. And that's something in the question and answer part of my newsletter that I've probably been answering for the last 3 or 4 months. There's been a number of, can you take a look at this company, take a look at that company, where are things going? And a lot of the focus is on precious metals and for good reason. And I think why a lot of people buy my newsletter in particular, maybe buy newsletters in general, is for that voice to say, hey, look, I've been through this before. I can see where the value is in the companies, and this is the point where you need to start moving your money into things that are unloved. And while that profit horizon may not be a year or maybe even 2 years out, this is where you're going to buy your best value, and this is where eventually you're going to want to be after the precious metals, it takes a little bit of a step back. No market goes straight up. And I think this is that next leg in the precious metals bull market. But again, you needed to probably be for the best profits, you needed to be in this at least a year ago. And if for junior stock for premium readers, if you were in here at the beginning of 2024, that's really when our portfolio took off. And it was getting ahead of the game that really put us in the position to maximize returns. And that's what I bring to my readers each week is that sort of level head and showing where that next step is. And to me, you look at copper, you look at nickel. This is where I think you want to be looking a year out, 2 years out, just like 2024, and looking where we are in 2025.
So, Brian, in all fairness, precious metals, yes, they've been running, but you go down to copper, nickel, they're very different drivers behind those metals compared to the precious metals. So, why do you think copper and nickel, in terms of the catalyst behind it, will show up more so than precious metals? Would that mean precious metals fade then? Because again, copper, nickel, they seem more industrial, more growth oriented than precious metals, which are more fear and monetary policy oriented.
You're bang on, Corey. That's exactly right. And gold and silver also, they don't really follow that supply and demand type dynamic. Excuse me. It's based on monetary policy. You're right. It's based on fear. This is what drives the gold price. And of course, when you see the US dollar really taking a step back in terms of its hotness, gold is usually that inverse. And that's basically what we're seeing. And I do think that continues into the future. But I think what you also see is that gold is a moniker for loosening monetary policy. And usually the market is well ahead of itself in terms of showing this. The market reacts before a recession happens. And then when the recession happens, that's basically when you're getting ready for the turnaround because stuff starts to ease, money starts to flow back in when things are easier and perceived less risky. And that's when things start to boom. And the same thing goes for the copper and the nickel markets. I think the reason why you see typically booms in base metals after gold market pushes is because that easing comes. And you could argue the fact that we're probably at a more risky time than ever in humanity's history. I wouldn't argue with that, with the wars that are going on, with where we are from a monetary perspective. But what I'll say is this, is that, gold is showing where we are. It's showing what is probably ahead. And I think while something could happen in the short term, I do think that we're headed for an easing, whether that comes with the Federal Reserve later this month or maybe towards the end of the year. I think that signal is being shone on the gold market, and it's going to show in the copper and the nickel market as they will react to an easing market. And that's why I think you look a year out and considering where valuations are, if you pick good companies that have catalysts that don't necessarily need the metal price to go up, then I think you're in the right spots. And I could give you a couple examples if you wanted that.
Well, yeah, that would be great to have a couple examples. I mean, I actually had a follow-up going a different direction, but why don't you walk us through a couple of the examples, the one you see that have catalysts that don't require higher metal prices?
Okay, so it's one that we've talked about on the show before. It's Hot Chili. They finished a PFS, much to the who cares from the market. And I get it, and for various numbers of reasons with the CapEx. If you go back to our conversation, it's probably a few months ago now, and I was talking about the importance of La Verde and what that might be in the future and how that might affect the Hot Chili's valuation and for Costa Fuego. And so what you're going to see is you're going to see the La Verde is going to come out with a maiden resource probably by sometime in Q4. And if this is up in that, let's say 200 million pound copper mark, that can make a huge difference in what Costa Fuego's and net present value is. And that's because if you took La Verde, it's near surface, it looks like it's a slightly higher grade. Let's say that higher grade is sort of erased by the transportation because you're going to truck it over to Costa Fuego or sort of in a mid placement of the mill. And this will come from the optimization in a feasibility study, what's going to happen next year. And that 200 million pounds will push out that underground development work, which is block caving. And that's really where the sticking point is because not only was the CapEx big, but it was early enough in the timeline that hit to cash flow hurt immensely. And everybody knows who does discounted cash flow models that you want to have the highest cash flows possible early on because that's what's going to give you the highest MPV. Because as you go on in time, that discount erases that cash flow out into the future. So if you can picture, you've got stuff going at Costa Fuego, you've got La Verde that's going to be now trucking ore over at a slightly higher grade, but probably around the same grade when it gets processed. And now you're able to push out that block caving capex, let's say 4 or 5 years, 6 years even. If you do that in the modeling I've done, and again, this is something I provide each week for my subscribers, I see a massive difference in MPV value. And considering that this thing, and especially when you look back when I first brought it up on your show, it's trading at almost double the price it was back then. And for good reason. They're heading towards this. The market can see that they went way too low. And I think people are starting to understand what La Verde could mean to Costa Fuego in the future. So this is what I mean why you could have appreciation in the share price, not just because copper price is going up. Let's say it just stays where it is. But the market should be able to tell that this is going to make a big difference to the underlying MPV and the investability of Hot Chili moving forward.
Brian, because you dive so much into these economic studies and you mentioned really the discount that a lot of these stocks are trading at, can we simply just do that? Can we look for the ones that are the most discounted right now and think that those can have, in a way, kind of a rising tide lifting them, but also that revaluation if they can get noticed by the market?
I would say that the precious metals market is probably more apt to that sort of thinking. I think if you're going to make a contrarian bet, you always want to look at each individual company as their own thing. You don't want to make any rules of thumb because there's just so much that you can't predict, like when the market actually is going to turn. And like I said, you're looking for specific stories that have specific catalysts that can potentially move that share price outside of copper ripping to $6. And so I think you want to be selective. You want to be very sure about not only the catalyst, but then the management's ability to execute on those catalysts. Do they have the skill set? Do they have the access to cash? That underlying story or arc might be there, but do they actually have the means to do it? And, that's that other part. And that can also be for the general retail investor sometimes when they don't have the time to do that. That's also where a newsletter writer like myself can help because that's what I do full time. And so that could be how you get in the right position or position yourself in the right way, looking a year, looking 2 years out, because I do think it's a case by case basis. And this is maybe where stock picking kind of shines is when you get to the contrarian bets and sort of position yourself for that next move.
Well, Brian, that's exactly where I want to vector in on because I've watched a lot of people pick stocks, and I think one of the biggest benefits you bring to your subscribers is the ability to pick stocks that have a growth case backed by data, backed by the models that you run. And you outperformed most other people that I'm aware of in the market last year, considering the portfolio you manage. And this year, you've done the same thing. You're definitely outperforming this year from discussions we've had off mic. And I think it's your propensity to pick winning stocks when they're not obvious. And I really want to focus in on the developers because that's really your sweet spot. A lot of investors never get past producers and royalty companies. And then a huge swath of retail are drill junkies. They're always following discovery stories or pre-discovery stories or, running around chasing the drill bit. You picked what can people consider the boring chunk of this, the developers, but have found a way to outperform by finding value. So maybe speak to your approach and how you hone it down to the companies that you pick in your portfolio.
Well, thanks for that, Chad. And I think it's something that I've had to learn. Playing to your strengths is such an important thing in this business as an investor, as a speculator, especially in resource stocks. And it's something that, over time I've made some big mistakes and had to sort of reprocess how I do my thing in the resource sector. And focusing on what I know and what I can add the most value to is the developers. And that is, you're correct. And that is what has made the portfolio stand out amongst the rest. Year to date, we're up around 260, 270% return for the year. That's 9 months in, and that is tremendous performance. And like I said, it wouldn't have been that way if I hadn't positioned the portfolio back in 2024. And really, that's the end of 2023. And that set us up to have such great returns. And again, I think this is where it's headed the next piece. And so how I do that is I'm constantly looking at valuations. Where's my best bang for my buck? And for instance, this week I was asked about another precious metals company. They had just come out with a PEA, and from the reader's point of view, that they were selling pretty cheap. And so I did my own calculations, reviewed the PEA, and I came out that the company was selling for about 13.5% of their underlying value laid out in their PEA. And in my view, that was quite expensive. And it was expensive because when you compare it to copper, when you compare it to nickel, but it was copper in particular, two positions that we've just taken or taken this year in hot chili and the latest one in surge copper, where you have NPVs that are selling for massive discounts. Like in Surge Copper's case, they're selling for less than 2% of their underlying value outlined in their PEA. And then just with the work that I've done on top of that, that shows the new metallurgical recoveries, the new recovery rates, where the molybdenum and copper prices are right now, you probably have about at least an improvement of 50%, 40 to 50% on the underlying NPV. And that's my calculation. And again, that's a step where I think in a year, 2 years, I think we can definitely get paid back. And in the whole scheme of things, while it doesn't have the sexiness, it doesn't have the rush of a drill result in the next week or 2 weeks or month. To me, there's a much higher probability that we will see that value recognized by the market. And it's something that I've seen over the course of my career, which at the end of, well, it was at the end of August, it was 9 years since I've been doing this full time by myself. And over that basic decade, that's what I've seen happen. And that's what I think what separates my performance from all the others.
So, Brian, with this simply better market environment, more money being raised, when you're looking at development plays or these more advanced assets and companies, everyone looks at financing risk. But financing risk seems to be considered a whole lot less right now, again, because so much money is being raised and because a gold bull market does also make people a bit more confident in other commodities. How do you factor in financing risk right now?
Well, it's all about that underlying valuation. And I think you have to understand that junior companies don't have any revenue. And therefore, you have to plan for what's going to be ahead. Like if a company has a resource and you know that they're going to be moving towards a development pathway, so you know a PEA is coming up, and probably a year after that, you're going to see a PFS and then an FS. When you start putting together discounted cash flow models, you need to start incorporating not only the costs of doing these studies and drilling being the big one, like what are they going to need to move that inferred resource up to a measured and indicated in certain deposit types, let's say vein deposits, which are pinching and swelling, they're going to need 25-meter spacings to basically get this into that measured and indicated area. That's going to cost quite a bit of money if it's on the upper end of resource size. And so you need to incorporate that. Not only that, you should incorporate G&A cost. One thing that doesn't go away seemingly ever is the cost of the executives. And you need to incorporate that into your model. And then I think you need to use that discount rate. That 10% discount rate is more reflective of what the cost of capital is today. So putting that all together, you've got the financing costs, which are going to be there. These things need to be put into development, and you need those catalysts to happen for this to actually get that share price appreciation. The executives are going to be pushing that, and so their salaries are going to be in it. So you need to take this all into account. And you can do this beforehand when you're looking at an opportunity. And really, when you put everything together and you put it in that DCF and you're proper about using a 10% discount rate that looks out into the future, then you can see what the actual opportunity is. And it shouldn't come as a surprise, when a financing happens and it's gonna cost $30 million and it screws up that market cap. You should always be able to find that differential before you get into a company. And it's not considering these factors that can be the biggest issue. And I think that's also probably what separates a professional investor probably from a general retail. So, when it comes to dilution, it is a risk. You want to make sure that you avoid those companies that are spending way too much money on marketing, on salaries, and not putting it into the ground, into other avenues that are actually going to add value. And that's going to be looking at the balance sheet. So, I guess the final thing is dilution's part of the game, but you want to make sure that you do the analysis beforehand to understand how it's going to affect what differential you have in profit. And remember that if the metal price isn't with you, that you probably need to be more conservative in what you think your upside potential is going to be. And so that's again something that I do for my readers, and I think it's something that can be adapted by anybody who wants to put the work in.
Yeah, some great points on reading the tea leaves ahead of time and kind of anticipating when the financings would come and how much they'd need to be so you're not blindsided. I think a lot of the newer investors to the sector, it's the financing risk that sometimes blindsides them and surprises them with the downside move. And if you can have somebody like Brian look into it for you or do that research yourself and read into the financials, you can kind of see that the capital raises are on the horizon. Just one last question for you from me, Brian, is that when you manage your portfolio, you keep a pretty tight ship and you're very selective about what you let in and what you let out. You have a watch list. But in this kind of an environment, especially in the precious metals where there's so much upside momentum, at what point do you exit a position partially or completely? Do you have any rules or systems around when you get out? Because some of your positions are up quite a bit. At what point do you ring the register on them?
It's a good question. And it's something that I think is sort of a moving target in terms of how I view it. I think that there's no general rule of thumb. I think if you look at a company and you understand the valuation and you understand where the share price and what's driving it right now, I think that tells you a lot about when you can take profit and when you shouldn't. If you look at a company that's sort of, let's say you've done the work, you've done the DCF, you've come up with a valuation, things are moving in that direction. The metal price is good and there doesn't seem to be any speculative movement, then I would say that's probably a situation where you either want to exit if you don't like what's ahead in terms of catalysts, or maybe you just want to de-risk the position. So you take 10%, 20%, 30% off the table. That's probably self-explanatory. In terms of, let's say, the gold market, I think this is a really interesting market to sort of contemplate your strategy because not only do you have companies hopefully hitting the catalyst and hitting the actions that they've outlined, but maybe you're even getting speculative attention via the market because the gold price or the silver price is going through the roof. And in that situation, you probably want to be cognizant of it because there might be an extra 10, 20, 30% laying on the table. And again, whatever you decide is up to you and whatever your situation is, whether you have another idea and such. But when it comes down to it, it's sort of a moving thing and it's a company by company decision you have to make. And I think you can probably make it a process and make it more rule based. But then you have to be comfortable with the fact that you might leave some money on the table. And in the end, I never fault anybody for taking profits. I think you absolutely have to in this business. And so for most people, maybe that makes the most sense. You just can't beat yourself up if you see that share price go up another 30, 40% just based on speculation. You have to be able to separate yourself from that. And ultimately, over the long haul, that's what's going to separate you from the general investor. Because usually the emotional ties is what screws everybody up. You become a bag holder, you ride to the top, you think it's never going to end, and you come right back down. And then that's when you actually have the capitulation to sell. And it's a story I've heard all too often. And it's something I've had to experience myself in years previous. And I've become a lot better at it. And I'd say if there's any lesson that any person, any investor can learn in the junior resource sector, it is to take profits and come up with some idea of how it best works for you.
Yeah, so true, Brian. We've all ridden stocks up and then right back down. And in all fairness, riding them up feels so good. And at the top, it usually feels the best because, hey, everything's going right. It's just going to keep on moving. And then it starts to roll over on you. And can't sell at this level. Just wait for it to get back to that old high. Oh, now we can't sell at this lower level. It happens. And I'm with you too. Take profits. Take profits along the way too. And most likely you're going to recycle that money into some other stories. And hopefully you find some other stories that are attractive that maybe provide some more upside. I also think taking some money and moving it into other sectors, diversifying a little bit more isn't a bad idea, but hey, riding some of this momentum, making sure you're in those stocks and those sectors that are moving higher, it just works for a lot of investors. And hey, hopefully these metals markets continue to move higher and we get some of that rotation into some of these other sectors and stocks like copper and nickel, as you've outlined. Brian, always great chatting with you. Again, Brian Leni is the founder and editor of the Junior Stock Review. Click the links in the show notes to follow along with what Brian's looking at. Brian, thanks for your time. Have a great weekend.
Thanks for having me, guys.